16th of June, 2023, Friday. Thank God it's Friday. Let's have a little break. But MA of hell once again. Now, Wall Street don't buy the tough talks, okay? And now the buying is extreme level. Practically anything the market wants to buy, they just buy it up. It doesn't care the fundamental, doesn't care it's overbought, the market just want to buy. And Wall Street now is really watching Federal Reserve and thinking, will Federal Reserve ever stop this bull? Let me tell you more in details. Let's go. All right, disclaimer apply as usual, and thank you, Ames, for the kind sponsorship. All right, so we can see over here on the heat map, wow, we can see it's incredible. Microsoft up by 3%, Meta up by 3%, Apple up by 1.12%, and even Amazon up by 0.5%. The thing is this, very interesting, Tesla is down slight, and of course the video too. So the two top running counters has been let go yesterday, but look at it. The NASDAQ broke 15,000 and stay 15,185. Dow Jones broke 34,000 and continued right up all the way to 44,408. And the S&P has now hit 4425. Wow. Now, yesterday was the 15th of June. And remember, I said that the peak should be between 13th to 15th of June. So just wondering, was last time the highest point the Dow will go? Oh, that could be interesting. But let us see what is shared. So basically, S&P and NASDAQ rallied for the sixth straight. Oh my goodness, as the traders hope that the Federal Reserve rate hiking cycle is nearly over. But the incredible part is that the dot plot actually says that there will be more rate hike. But the thing is, Wall Street just don't give a damn. No, this is incredible. So the thing is, right now, we know that now we are at 13-month high, as investors bet that the Federal Reserve is not going to raise any more interest rate, while Jerome Powell has reiterated that there at least be 2 more to go. So this is incredible. I thought we shouldn't fight with the Federal Reserve, right? But seemingly the market don't care, don't bother. All right. So the thing is right now, we all know that Federal Reserve says that they will still look into account and see how the current situation is to make a decision. But the Wall Street ticket is point out, okay, this shows that the Jerome Powell most likely may not rate hike. So that is why the market is buying. And of course, the very interesting thing is the weekly jobless claims was slightly above estimate, 262 over 245. So again, this number tells me that the numbers are showing we are actually getting nearer and nearer to recession. So the thing is this, is either Wall Street knows about it, but they don't give a hoot what's happening, or they are being instructed to just push the market as high as possible so that later on the selling can be really, really bad. So now the fear and greed index, oh my goodness, is at 83 right now. And this is the one of the highest level. Let me bring to you right now, guys. This is really insanity. All right, let's take a look over here. So this is the fear and greed index, and you can see right now we are really off away from the moving average of 4056. We're now at 4425, so which means that we are really 300 point away from the usual average out. This is incredible. The stock price strength is really at the high level. The last time we saw something like this was back in April, and of course much higher was in February, right? That's why the market caved in. And of course we can see that the market, the stock price breadth is now also at an extreme greed level. This is not a good sign at all. And of course, furthermore, the thing is this right now, the put call ratio, the put call options that really at the low level is even lower than what happened back then again in August last year before the market rebound. So again, extreme buying, complacent, and of course the VIX continue to slide, staying below 15. That's a very bad thing. And of course, right now the safe haven demand is at a high level now, extreme greed once again. And of course, the junk bond demand, basically no fear. So everybody has done it. So that's why it's considered extreme greed right now. So with all this thing at the bottom, I mean, at the extreme level, what do you expect to see? Buying? Well, if you look back again, this chart, let me just bring to you one more time. Let's scroll up all the way, take a look in the timeline. Oh gosh, we are now back at 83. And the last time you see 83, guys, the last time you see 83 or 82, in fact, was 1st February. And that's where the market actually turns down. Remember, that was back in February this year itself. We can see that. This was the February where the Dow was trading at around 34,000, and it went sideways for a couple of days before coming down all the way to 31,500. So the thing is this, guys, don't forget. Now, where are we right now? We are just again back to where we started. So hence, therefore, kind of believe that things will just repeat again, right? So what do you think? Let me know in the comment box, okay? All right, so with that, we can see that right now the market really don't buy into it. In fact, many of them think that right, Jerome Powell is just bluffing because they don't think that they will hike it and cause a banking sector collapse. So with that, right, we know that the funds trade Tom Lee always been bull. He's now upgrading his call to 47.50 for the end of the year, and that's about 9% from where we are. And he believed that the Federal Reserve meeting actually gave the stock market a green light to buy further. So this is incredible. So the thing is right now he's overweight on tech, meaning he's buying on tech, energy, and industrial. And he's picked Microsoft, Nvidia, ExxonMobil, Occidental Petroleum, interesting, same as Warren Buffett, and American Express, and Pfizer. I think that is the financial stock, yeah? All right, so what do you think? Do you think the S&P will go to 47.50? Well, I think it will, but not now, in my opinion, yeah? So let's understand this. The yield curve hits the deepest inversion since 1980s. So what does it mean? That means that we are actually very, very near to a recession. So let's take a look on this video. Let's go.
The yield curve is front and center of the news for the better part of the year now, as the inversion between the 2- and 10-year treasuries recently reached its widest level since the early 80s. In normal economic times, bonds with longer durations generally have higher yields than bonds with shorter durations. But when shorter dated bonds yield higher rates than longer dated ones, this typically precedes trouble in the economy and has been a very strong indicator of an upcoming recession. This is because it can stifle the economy with tight credit conditions, which are reflected in weak future growth and inflation expectations. But now, some sections of the U.S. yield curve have been flattening. History suggests that this may not be very optimistic. The shift more likely indicates that an economic downturn is imminent, which could lead the Fed to stop the rate hiking policy. The yield curve experienced a very similar shift in early 2007, and a few months later, the financial system was facing a major crisis. A global recession followed, and the Fed started cutting rates quickly.
So probably this is the reason why the Wall Street believed that there could be a rate pause soon, because the inversion is so deep right now. That means that if they continue to rate hike, that will definitely cause a recession, or at least what they are saying right now. And you can see from the right side here, you can see Mike Wilson on the earnings, recession calls, AI segment, he's still kind of bearish, while this guy Herman is looking at a recession by summer. This is interesting. So what do you think, guys? Let me know in the comment box, and let's see why I think the market may take some profit soon, because the Treasury, remember, they need to target $425 billion June cash balance to start the post-debt ceiling replenishment, all right? So they need something about $350 billion for all this important movement. Hence, therefore, right, this will start from the 15th of June, which is yesterday, and they are now about 125 billion short from the $550 billion needed, and usually that will put on downward pressure on liabilities as bank reserve balance, stock market, options market. Just take note of that. So if this is a way to look at it right now, meaning that the market may be pushing up because they know that they need to submit some cash back for treasuries, hence therefore the pushing was there. So JP Morgan says that the stock market may suffer $150 billion rebalancing sales. So they are saying that right now, right, there is a chance, because of the balancing needed, they will create a 3 to 5% correction in the equities market. So this is actually viable and it's more practical, because I also believe that if the market will pull back, right, we're going to see about 5 to 8% pullback. So if you look at S&P right now, the market now, the last time we saw this back in February, where everybody was so optimistic and everyone thinks that the market won't crash. That was what happened back then in February. And of course, the market eventually pulled back by 9%. So if this is the same thing happening right now, where the CNN data are all the same, then a 9% pullback, if we talk about mimicking it itself, should be able to bring the S&P down all the way to 40.66 level. All right, so there's something to take note as a guide. But of course, if the market want to continue to ride and break the last high, the cycle high back in this 2022, that will be all the way to 4,500. Well, some traders are looking at 4,500 to be tested first before the market comes off. All right, so for me itself, I think that the high should be between 44.50 level. I think somewhere around here should be it. I don't think you'll go any higher than that itself, because I believe that after that, the selling will come in. Now, take this high, very important, this high itself is about 43.50. So if the market actually breaks below 43.50, then that should be the catalyst for some profit taking, because you can see right now the RSI is really, really at a very high level. And of course, we all know that when the RSI is high, we should expect to see some selling. But the last time we saw something like this, the MA 200 was actually on the bear side, but this time around the MA 200 is on the bull side. So I think that this may take a while for it to really manifest. What do you think? Let me know in the comment box. Yeah. Okay, at the same time itself, right, we all know that today is a quadruple witching, and definitely because of the expiration of the stock index, stock options, index futures, and single stock futures, we expect a lot of action later on. And based on this, the SPX plus SPY total notional open interest based on today, you can see that it's very, very high. And the last time we saw something like this, the stock market actually fell. So what do you think? Do you think that this will repeat? I think it will happen, because when everybody's buying it, if you definitely they're going to do some turnaround, some killing off, so that they won't be paying the free money to someone else, right? So think about this, yeah. And of course, to buy now at the PE ratio, yesterday I talked about it, it's at 24 right now, a PE ratio. And for the forward PE ratio, it's at 18 now. And 18 is considered high because the mean average is about 16.8. And of course, the best time to buy will be somewhere around 14. So at this moment now, there's no cheap stock at the moment, or at least for the top counters, right? And the PE ratio, as of yesterday, just double check again, it's at 22.23. So again, it's at high level because the average mean itself is about 17. So again, both forward and current is actually at a high price. I don't think you should chase the market. But one thing to take note of, the Dow Jones must stay above 33,800 because that's a 61.8. Now, 61 points is a very important technical level. And you can see that every time the market goes above it, yes, it does go higher. But once it breaks below it, the selling can go down all the way to 32,280, basically itself down by 118. Right, so it happened again. You can see the market really keep on doing the same thing. So if you ask me yourself, if the market continue to go higher, that'd be good. You can go all the way up to 35,000. Okay, that is possible. But the thing is this, if the market pulls back, you can see last time, right, the market came down 2 days ago, it stopped there perfectly at 33,800 and rebounded. So this price itself seemingly is a very critical price. So if the market breaks down, it must able to stay at 33,800. Any breaking down should see a free fall all the way back to 32,800, and that is where the MA is. So I kind of believe that this may actually happen. Yeah. So watch out for 33,800 on the spot market. As long market stays above it, you are still fine. All right. So that'll be all for today. Thank you very much. I hope you enjoyed this video. This is Cal signing off. Have a good weekend. Bye-bye.